Stop overpaying taxes. Learn deduction every business owner needs to know. Did you know that if you don't know the right tax deduction for your business, you might end up paying more taxes or even get penalties for wrong deductions. The government allows you to save taxes on certain expenses, but only if you know which one are allowed. Today, we will learn about more important tax rules that can help you save more money and run your business without any trouble. First, let's talk about Article 28, which explains which expenses you can subtract from your taxable income. You can only subtract expenses that are directly related to your business. For example, buying equipment for your business is deductible, but personal expenses like buying a car for yourself are not. You can deduct that cost, but if you bought a new TV for your home, that would not be deductible. Now let's talk about Article 29, interest expenses. Now let's talk about interest on loans covered in Article 29. There is a rule called Thin Capitalization. It says you can only deduct up to 30% of your EBITDA, your business income, before interest and taxes for interest on loans. If you have more interest expense than this, you can carry it over to the next years, but only up to the 10 years. Example, if you have paid too much interest this year, you can carry it over and reduce next year taxes. Now let's talk about Article 30, General Interest Deduction Limit. Article 30 tells us that if your interest expenses are less than 12 million dirham, you don't need to worry about the limits. But if it is more, you can only deduct either 12 million or 30% of your EBITDA, whichever is higher. For example, if your interest is 15 million dirham, you can deduct 12 million or 30% of your income before tax and interest, whichever is higher. Let's talk about Article 31, which talks about interest on loan from related parties. Article 31 says you cannot deduct interest on loans you get from your family or friends for things like paying dividends, buyback of shares, or giving money to a related company. For example, if you borrow money from your relative to pay a dividend or buy back your company shares, you cannot deduct that interest. So let's jump on to the Article 32, which talks about entertainment expenses. Article 32 allows you to deduct 50% of entertainment costs like meals or travel when you are meeting business partners or the clients. But remember, only the costs related to the business meetings are allowed. For example, if you take a client to a lunch for a business meeting, you can deduct half of the cost. But if it is a personal lunch, it would not. Now let's talk about Article 33, non-deductible expenses. Article 33 explains the expenses that you can never deduct, such as the dividend, bribes, fines, or taxes you pay to the government. So now you know which expenses are deductible and which are not. Following these rules helps you to save taxes and keep your business on track. If you are unsure about any tax deduction or want to be sure you are doing it right, it is always good idea to talk to a professional. Thanks for watching, and don't forget to subscribe for more tips on saving taxes and growing your business.